Let's talk about the broadening risk rally and whether or not ultimately that is a good thing or a bad thing at an index level. What do you think?
Well, this morning we're not seeing a large amount of that broadening the risk rally, but I do think it's a theme we can expect to see. I think it is a good thing. It's going to be problematic for some people because I think there's two parts to this. I think one is we're seeing Powell's dovishness is opening the door for easing around the world. That's why we're seeing front-end yields come lower generally. It's providing a more supportive environment, and it should also help to kind of keep the dollar capped and may even see the dollar soften, and that will be an easing of financial conditions. So I think around the world we can see risk assets do better. Another part of it, though, is rotation, which we've seen glimmers of last week. And I think we might see some more signs of that in this kind of earnings season. And I think it might be facilitated by what we're seeing coming out of Trump's kind of surge in the polls and the fact that he's now appointed J.D. Vance as his VP. He does have a history of fighting with big tech. Even if he's got some key allies in Silicon Valley, he's generally said he wants to break up some of the big tech. So I think that kind of theme of that new Republican momentum and what we're seeing from Powell and just generally what we're going to see out of this earnings season might facilitate big tech maybe pausing a little bit while the small caps catch up, value stocks catch up, the rest of the world catch up, and I think that'll be a good thing.
Mark, I want to come back to that Trump trade in particular. We're talking about the steepeners being the easiest, most direct play out of it, but how much of the roadmap in terms of the French bond market applies to what we might see in the U.S. bond market if at the core of both issues is a expanding and a quickly expanding deficit? Yeah,
I'm not sure I kind of like the idea that this steepening is seen as the ultimate Trump trade. I think that this has coincided with what's happening on the economic side. Powell and U.S. politics together are combining to help the curve get closer to disinversion. I know 2s30s has already disinverted, 2s10s hasn't yet. And I think that we can see that dynamic happening. And what's happening is that we are seeing on the monetary policy side, again, the Fed try to push that we are very close to starting the easing cycle. And that helps the front end come lower or at the very least be capped. On the other hand, we are having political policies from both parties that do not show a great concern about the fiscal situation, which should see long-end yields come higher. Now, if you combine that with what's associated with the Trump trade of like stirring growth and being good for the economy, well, then that may, and being pro-inflationary, well, that seems even more so that you should see the back end come higher. So yes, this is a trade which is working and tallying with the narrative of Trump surging in the polls, but I don't buy into the idea that this disinversion of the curve or this curve steepening is all about Trump trades in particular. It is the Trump narrative tallying perfectly with what we're getting from Powell, what we're getting on the economic signals. And do I think it's sustainable? Yes, I do think that overall in the second half we'll see that. And remember, it's when the curve disinverts that a recession looks imminent, and that's worrying.